Welcome. This is the Real Estate Investing Mastery Podcast. Real Estate Investing Mastery Podcast co-host
Part 2
extraordinaire Joe and Alex. How are you, Alex?
I'm good. I'm ready for part 2.
Yes, this is part 2 of our podcast interview with Bob and Jimmy Vreeland and Bob Scott, both from St. Louis. I'm looking forward to hanging out with them real soon here. And they've been in St. Louis for a long time. I think, Bob, I might have met you before. I am a hermit. I'm a self-confessed hermit. I have 4 kids, though. It's just I never go to any of the RIA meetings here. I should, but I don't. But you guys are just tearing it up in the St. Louis market. If you guys listened to episode part 1 that we just did with these guys, we talked about how they have 110 houses in the last 2 years. They're buying these things with some private money. They are selling them on lease options, and they're having a lot of really good success with this business. They're making very good money. Both military folks. Before we get too far along in this, I want to give you their website so you can look them up and reach out to them, talk to them. We're going to be talking today about some really cool stuff with insurance and private money and buying these houses. But their main website is jointopsproperties.com. Jointops, O-P-S, properties.com. And they also have some videos out there on YouTube. Go check that out. They also have a website where they teach some of this stuff at autopilotassets.com. And Jimmy and Bob, let's talk about this a little bit more here. What does real estate and life insurance have to do with each other? Makes no sense to me.
Okay, so gotcha. So the 6 primary advantages of real estate, it turns out that investing in a whole life policy, it shares the same advantages. So would you agree people should invest in real estate because of cash flow, leverage, and tax advantages just to get started?
Absolutely.
Yeah. Yes.
Okay, so the way I look at it in my mind, it's not that I love our average 1,300 square foot house with 3 bedrooms and 2 baths, right?
Okay.
I'm not particularly passionate about that. I am particularly passionate about a cash flowing asset and an asset that has tax advantages and also an asset that I can use leverage with, right?
Yeah.
So if manufacturing widgets had those same advantages, I would do it yesterday.
Okay.
So when I discovered life insurance and realized that, whoa, it cash flows, I can use leverage, and it has tax advantages. Well, to be honest with you, once I saw it was another way to pay less taxes, I was in. Tell me the details later.
I'm all about that. What can we do about that?
Okay, let's just start there.
Okay.
So, Alex, last time we talked, you have $40,000 in a whole life policy.
Whole life policy, right.
Okay. And so right now you're probably getting 5% tax-free compounding.
Potentially, yes.
So if you were a private investor on certain properties, if you got that deal, you wouldn't be disappointed. You wouldn't be heartbroken, right?
No.
You'd be destroying what anybody's doing in the market right now.
Absolutely.
You'd be crushing.
If he was making 5%?
Yes.
Okay.
You'd be
because
crushing
banks are only doing 2 or half of 1%.
Right. And you'd be crushing any qualified plan out there right now.
Absolutely.
Do we got to keep going with the podcast, or is everybody ready just to go put money in life insurance?
Well, I'm looking here at CD rates. And CDs at bankrate.com will get you 1.3% interest.
Wow, I was pretty darn close. I was able to finally find my login here. $39,972 in the whole life policy.
Nice. So you're already getting 5%. Why wouldn't you take a policy loan from that money and go get whatever percent return you generally get on any of your real estate deals?
So like what? Okay, I can't do anything really with that money. Well, let's see. Okay.
Let's say you were a private lender of ours.
All right, wait. Ready? Okay, I just bought a property yesterday for $40,000 that I'm going to flip. Maybe It's potential new construction. I could subdivide it, sell off the lots, or build it out myself. But let's say I took this money and I went, can I take all of it and go buy a lot with it?
You can take all the cash value, yes.
Okay, now what?
How'd you get the 40 grand to buy that lot?
I took it from myself.
You had it just sitting in the bank.
Yes.
Okay, so if you were to take it out of your policy, you're going to start getting an and one in your money. Your money's going to start working in two places at once. It's still going to get that 5% dividend from the life insurance company, and then it's going to go get whatever return you can go get in this next deal.
It's going to get a return that I'm going to get on this next deal. Okay, so if I held it for 6 months, let's say, now what?
Well, when are you going to actually get your realized gain from this?
So let's say I buy it, I sit on it, I subdivide it, I divide it into 2 lots, and now I'm selling the double what I paid for it.
Okay, so you're going to get 80 grand for this.
Right. Let's say that worked.
Yeah, in this example, the only difference is that 40 grand is still getting a 5% return while it's working in this other deal.
Okay.
So if we're comparing it of you taking money from your whole life policy or you taking money just out of your bank, right up front, you're still getting a 5% tax-free return.
Now, what do I have to make payments on this?
When you die.
That's what's great is you can
No. Now do I need to make payments if I borrow it?
From the loan?
Yeah.
No. It's at your discretion. Like, we would recommend that you would treat it like a bank and you would make periodic payments back, but you don't have to, because the life insurance company knows you're good for that 40 grand because they probably owe you 1.3 or 1.4 in death benefit, right?
Right. Yep, you're right.
So right now that 40 grand in that policy is just dormant, sitting doing nothing.
Doing nothing. Right.
So why would and you as a real estate investor, every dollar you get into a deal, you probably make $1.50 to $2 back, right?
You would hope.
So any dollar you can get a hold of, you should put in a policy so it's always getting that 5% return tax-free. And then you as a talented investor is always getting $2 return on that investment.
Okay. Now, when you say return tax-free, okay, so let's say I pay back my policy after I sell the property, the $40,000 goes back into my policy. Now what? I also realized the $40,000 profit.
So the profit on the separate deal is taxable, but I would put it into another policy, and then it will continue to get 5% tax free, and then you still have access to that new capital.
So how much life insurance can you pull out on yourself?
Depends on your human life value, and at that point, you need to start talking to the actual people who work for the life insurance company.
Yeah, based upon your annual income and your balance sheet, your family, and all that kind of stuff. But most of us, you could easily probably get $50,000-$100,000 a year premium pretty easily.
And the way we stumbled upon this is we were probably at our 50 or 60 property mark, and we started getting resistance back from the banks. And the bankers were like, we want you to have, if we have $1 million out with you, we want you to have $200,000 in our bank. And we're like, you're out of your mind, because we could go buy 4 more properties with that money. Right. And so we discovered privatized banking and Nelson Nash's book. If we put that same $200K into a life insurance policy, the bank on our balance sheet, it is an asset of life insurance, which the banks still count as liquidity.
Okay, so when you said put the same $200K, you can't just up and put $200,000 into insurance policy, can you?
You can if you build it out. I mean, it's going to take a little bit of startup time, but yeah.
My advisor, I just was looking through some of the emails I had over the course of since I've had this policy. And he said I have a PU of $9,000. What does that mean? Paid up something?
PUA?
Yeah, PUA.
Yeah, maybe that's what that is.
So, and then what is your annual premium?
I think I pay like $300 a month.
So 36
So basically, the way they structure it, we don't have to get into too much detail on it, but there's like a core policy and then a paid up additions rider.
That's it. Yeah, paid up additions rider. Yep.
And they do this so they can basically maximize the cash value day one on these policies. So for people like us who want to have access to that cash, we have as much as possible day one.
Okay.
So my guess is your financial planner, whoever set this up, he's not trying to maximize the liquidity of the policy for you.
Well, when I did it, I was only 22 years old, I think. So.
Right. So he was doing something safe and secure in a kind of a forced savings plan.
Yes, absolutely. Yep.
So there are policies out there designed specifically for real estate investors that maximize the liquidity of the policy.
Okay.
And so after we stumbled upon this, that on our balance sheet, it looks like it's a liquid asset to the banks, that solved our kind of liquidity crunch. And then once we realized we could pull loans out off that money and keep the money working, it was game on for us.
Okay, so what would you do if you had, right now I have $40,000 sitting in this account. What would you do?
I would have used it to pay for this next deal.
That's what you would have done.
Absolutely.
Or your next deal that's in the pipeline, or make a private money loan. There's a lot of ways to do it.
Make a private money loan. So lend it out at stinking 12%.
Right. Yeah. So you get 5 from the insurance company. You get 12 from whoever you lent it to. You have to give 6 to the government probably, but at least the insurance policy offsets the tax liability.
Why do I have to give 6 to the government?
Most of our investors are in the top tax bracket. So it's taxes over income.
Yeah, gotcha.
So our investors love us when we came up with this solution.
So the money you earn is not tax-free like a self-directed IRA.
No. Well, and then here's the thing about a self-directed IRA. Like, you're going to pay taxes on that one day, right?
Not if it's a Roth.
Is it tax deferred or is it tax? The Roth is
Roth is after tax dollars.
Right.
Okay. Right. So it's just in a Roth, you're investing in the market, and I don't think you're going to get 5% compounding and perpetually. That's just my hunch.
No, you're not.
And so I know a lot of people, they invest in their qualified plans because they don't have they get a tax break that year. But I've always hated that, because I've always planned to retire a lot wealthier than when I'm working. So you're going to pay higher taxes when you take it out when you're retired.
Right.
You're wealthier.
That's the problem with tax deferred, right?
Yeah.
Right.
And then you don't really have access to that money in the short term. With the whole life policies, you can take a policy loan for whatever you want. I mean, it's essentially your money you're parking there, and you're basically a shareholder of the life insurance company. So if you want to use this money for vacation, for pretty much anything.
Now that would not be a good idea, right? That's not a good idea.
Well, once you get really into the concept, you're going to try to make every dollar you touch hit a policy. So you'll eventually start taking loans on money you're going to spend.
So if you're going to spend that money on a vacation anyways, you park it in your policy first and then take a policy loan against it to pay for the vacation.
Instead of putting your vacation savings in the bank.
Okay.
So I'm still unclear on one thing here. If you have a deal, you borrow money from your insurance to pay for that deal, do the profits of that deal have to go back into your insurance policy, or just the investment has to go back?
Just what you pulled from the policy.
And so even
what
while
were you
the
talking
money,
about? Go ahead.
Alex, even while the money is out, you're still earning interest on it from the insurance company.
That's the great and one, Joe. It's just like basketball. You get fouled, and then you make the 2 points, and you can still get that other point. Your money, why real estate investors love this infinite banking is because your money's working 2 places at once.
But the only money you can take out of your insurance policy is the cash value that you've put into it.
Correct.
You can't take any more than that?
No.
And so with these specially designed policies, basically by year or by month 30, every dollar you put in the policy becomes liquid. initially 25% of what you put in the policy is not liquid.
And so that takes usually 30 months to get to that. Is that what you said?
Yeah. Right. So I got it when I was like 22 years old or something, right? And it took a while for that to start kicking in.
But I'm sure every dollar you put in it now is instantly liquid.
Okay.
All right. So let's say somebody's interested in this. One of the things they could do is, go out and get one of these life insurance policies. But you can't touch that money for 30 months. What?
No, you can't touch 25% of it for 30 months. Okay. You can touch 75% of it 24 hours later.
Oh, okay.
Especially if you're a private lender. This, over 10 years, can add close to 50% to your return.
Interesting. And when you find a private investor, you have them talk to your insurance guy.
The first call is to me, and the second person is to our insurance guy. Yes.
And so, describe again the conversation that insurance guy has with that private investor.
So the insurance guy is going to go through the real X's and O's of the policy and how it works. But, the 30,000-foot view is that if you are a life insurance policy holder, you no longer, you're escaping certain taxes that you can't escape anywhere else.
Mm-hmm.
And you're escaping the taxes on the money that it's gaining as you are. You're not escaping the gain from the tax of the deal you are doing, but you're escaping the tax of the policy gaining as you're doing the deal.
Right.
Correct?
As soon as you enter into this policy, you're going to get a 5% dividend compounding tax-free, which destroys probably 75% of the other investment vehicles on the market right now.
You said as soon as you enter the policy?
Well, as soon as that money, your money enters the policy, you pretty much can count on a 5% compounding tax-free dividend.
Forever.
Okay.
And then you still don't lose the opportunity cost of that cash because you can take a policy loan at any time for any deal that you have.
Right. Opportunity cost is big. Yep.
And then you guys both have 4 kids. And so when you die, that death benefit transfers to them completely tax-free.
Wow. That's pretty cool right there.
Yeah. And when you really get deep into how to do this, you take a policy out on your kids so you can start teaching them about banking and cash flow and investing.
So I should pull a policy out on my wife and all 4 of my kids?
Yep.
Now, some people are...
So the child policy is strictly a teaching tool. It's not financially, it's not going to do any better than just putting it out on you and your wife.
Okay.
But I'm doing it on my kids just to teach them. We're kind of weird, but I take my kids' piggy bank money and make them private lenders in our business. Just so they understand. But I show up to them on the 15th with 75 cents and I'm here's your interest.
That's
nice.
Cool.
But it's just to teach. But for your wife, I put a policy on my wife for sure. And this was all money I just had sitting in a bank doing nothing.
All right.
The other kind of interesting thing is Jimmy's got this phrase you're essentially collateralizing your death, and we don't get too dark of things, but let's say for whatever reason you've parked that $40,000 in there, and you take a policy loan, the entire deal goes south, you lose all the money. You still got the death benefit there. So it's kind of like a permission slip for you to go out there as a real estate investor and take some risks with your money and still have your family protected in the long run.
So, and then me and Bob, we needed a buy-sell agreement, right?
Yeah.
And if I were to die, my wife has no idea how to do real estate or do this company. So we got a buy-sell agreement and put policies on each other to, in the event either of us die, it pays off the debt on the properties, and then the heirs still get the cash flow from the properties. But where it's really fun is our property tax liability is about $100K, right?
So we're going to pay about $100,000 in real estate taxes this year. So we've got to escrow that money anyways and have it sitting on the sidelines,
waiting for something. So we were like, well, why don't we just put that into a life insurance policy? And so we did that. At the end of the year, when we pay our taxes, we pull a policy loan, we pay it to the government, but we still get a 5% dividend on money we're giving to the government.
And then the policy is built around for worst case scenario, like I said, our buy sell on the company to pay off the rest of our portfolio.
I was just doing some research the other day, a few weeks ago, about annuities and whole life insurance policies. From an investment standpoint, you could maybe make the argument that it's not the best investment. But when you're talking about using that money for investing in real estate, it makes sense. Am I on the same page?
I mean, life insurance isn't going to make you rich. Real estate can make you rich, but life insurance will make your system more efficient.
What somebody's going to say, though, aren't the fees and commissions really high in these life insurance policies?
They're going to be upset about the 25% that's not liquid day one, right?
Yeah.
And generally, most of that 25% goes to commission to the broker. Now, I have an abundance mentality. So if someone's creating value for me, I don't get angry the fact that they're making money doing that. But over the long term, compared to a term policy, you pay more up front, but you get it's better long term.
Yeah, these things are, if you're short-term thinking, this is not something to do. Where these policies really start working for you is 20, 30 years down the line, when you've been tax-free compounding all along and you've been rolling more money from your real estate business back into the policy.
And so if you buy a term policy, yeah, the premiums are cheaper, but if you get sick under the term after your term expires, they won't reinsure you. At 37 for me, if I buy a policy now and I get sick, in 5 years from now, they still have to insure me and I can still be putting money into the policy.
Right.
So term is like renting life insurance. Whole life insurance is like actually buying the asset.
But I've never heard of it this way before, using that to invest in real estate. Because now you have a huge market of private lenders out there that have cash value in these policies. And so you're telling them, listen, if you want to make 10, 12% on your money, you can invest in real estate, and you can still earn the 5% that your life insurance is paying you, while the money is being used in another real estate investment that's making you 10% on your money, right?
Yep.
Are there ways you can invest the money from an insurance policy through an IRA?
Yeah, Joe, their qualified plans are horrible. They're a government monstrosity. They shouldn't exist. There's no free market reason they exist. It's just because a bunch of bureaucrats got together and created a subsidy for Wall Street. Subsidy, or better word than that, but.
So what do you mean by that? So are you saying that self-directed IRAs are not good, or
not if you're gonna? I took my 401k from my old job and put it into did what you're talking about, a self-directed plan, right?
Uh-huh.
And there's no advantage that life insurance doesn't give you that a self-directed IRA gives you. Except I feel like dealing with my self-directed IRA is a pain in the ass.
Interesting. So you don't have all of the requirements in your insurance for what you can and can't do with the money, correct?
Right.
And you still get the tax protection, the tax shelter in your life insurance?
Yes.
It's not like doing an entire deal if you're doing a self-directed IRA. But if you look at the long term, with the earning the interest inside of your policy and having the access to the cash in case you need it. We think these life insurance policies far outweigh the self-directed IRA route.
Interesting. I've never heard anybody else talk about it like this before. So talk to the investor out there who's fixing and flipping some homes, wants to borrow some money, needs some private money to buy a deal, and he's looking for some private money, and he finds some people that have some of this cash value insurance.
I guess. So there's the Nelson Nash Institute. If I were them, I would go to financial planners who are selling this and have customers with cash value just sitting doing nothing. And that's what we did. And so you'll have the financial planner explaining the life insurance angle to the investor. And then, I mean, people who invest in these policies, they'll get it. If they could see a 10% return from real estate and it's not in the market, it's not that hard of a sale. We've raised quite a bit of money doing this strategy.
And how do you find these people? Is it through the financial planners?
If you go to the Nelson Nash Institute and look for, it's called Infinite Banking Concept, so IBC practitioners, it has a list of people who sell these policies. And the people who sell these policies know the people who have the cash value in the policies. Like I don't speak at like REI meetings right now. I go to life insurance meetings and talk about real estate. I
just saw the infinitebanking.org website.
Well, you guys read Rich Dad Poor Dad, right?
Yeah. Mm-hmm.
And so the paradigm shift with Rich Dad Poor Dad is don't get taxed like an employee, don't get taxed like an investor, right?
Yes.
And so it's the same paradigm. When I saw life insurance, it was the absolute same paradigm shift. Like, don't invest in banks, invest in what banks invest in, and banks for their tier 1 capital use life insurance.
Yeah, it's called BOLI, bank-owned life insurance. Every major bank out there has billions of dollars. This is like where the banks and large financial institutions are parking their money, and they get policies on all their key man as well, key man policies.
Right. And you guys know what tier 1 capital is, right?
No.
So banks have to keep a 10% reserve in what they have out in loans.
Okay.
So they have to have 10% of liquid capital or liquid cash out or in their reserve if they're lending money out. So if they have $1 million out in loans, they got to have $100,000 in liquid capital. And so instead of keeping it in cash, they keep it in cash value and life insurance on their key employees.
Interesting. Well, are there any drawbacks?
The initial 25%, that's illiquid is a drawback. And then, you need to make sure you can fund the annual premiums. But the thing about real estate investors is they have cash circling around them all the time. So they could always put it into a policy and then pull it back out.
Yeah, so let's say if you're committed to a $20,000 a year premium. On the low end, you might actually have to, on a minimum year, maybe put $3,000, $4,000, $5,000. It depends on the policy. So you said, hey, I commit to $20,000. I'm having a bad year. I can only put in $5,000 this year. But if you go for 5 years past that point, you can retroactively put money back into the policy. And if for whatever reason I'm short this year, I could say, hey, Jimmy, float me the $10,000, $20,000 to put into my policy. Then 24 hours later, I send it back to Jimmy, and now I've fulfilled my commitment for the year to the policy. So there's a lot of workarounds if you have a bad year.
And even if you're a flipper and it's part of your working capital for your flips, you can fund the premiums with your money while you're in between flips, even though it's going to go right back out into a project.
So I'm looking here at YouTube, and I see there's a bunch of videos here. I just did a search for
the life insurance stuff for me is really hard to get until I could start seeing the numbers drawn out for me. So there's a few case studies there, And when you see the dollar amounts and how you're making money inside the policy and then outside the policy, I think it'll really click for a lot of people.
Interesting. Okay, so what would somebody need to do to get more information or education on this?
Go check out our YouTube channel. We got a bunch of videos on there. And you can also check out the guys at Atlas Wealth, Ryan and Brad. Those guys know way more than we do about this, and they're the ones we've learned it from. And the great thing about them is there's a lot of people who sell these policies, but those guys are real estate investors themselves, so they know how to structure it specifically to maximize the benefits for guys like us.
And then if you're in St. Louis, E3 Wealth, John Moriarty, he's the local guy doing the most with this right now.
E3wealth.com?
Yeah.
Okay, I see.
But then the Atlas guys are like you. They're in Brunson's mastermind, and we should probably create a squeeze page for this.
So is it atlaswealthadvisors.com?
Atlas Wealth Solutions.
Atlas Wealth Solutions.
And you keep saying to us like, "Wow, I've never heard about this." And to be honest with you, 5 months ago, this is what we were like. We read Nelson Nash's book, and we were furious. No one had ever discussed this with us.
Okay, so your YouTube channel is, I know I just read it to you guys. You told me what it was.
Yeah, just Joint Ops Properties. Search that, and you'll see it.
And
we have the case.
Go ahead.
We have the case studies in there with the numbers, with the Atlas Wealth guys go through the numbers, and basically I'm just on there popping off.
Want to talk about the Harbaugh thing too?
Sure.
Oh yeah, you mentioned Jim Harbaugh.
So Jim Harbaugh, to avoid something like $5 million in taxes, he has the University of Michigan pay him in loans that he has to go buy life insurance premiums with.
Interesting.
And so it's a great deal for the University of Michigan because they probably charge him 3 or 4% interest, right?
Yeah.
And they know he's going to die, and that interest keeps racking up. That interest keeps racking up every year inside the policy, and then when he passes, the principal of the loan plus 4% compounding will go back to the University of Michigan. While the whole time Harbaugh is living, he has access to that cash to reinvest in other deals, and he's basically arbitraging the money in a policy that the University of Michigan gave him. And it's a somewhat complex structure, and on our YouTube channel, there's a 20-minute video that goes through it.
All right.
But at the end of the deal, and if he gets paid in life insurance premiums, he gets his compensation basically tax-free.
Interesting. Well, any tax advantage that you can get is a good thing, and
it's just like Kiyosaki, teaches people to do. Be taxed like a business. Be taxed like a bank or a big corporation. If these guys are doing it, it's okay for small puds like us to be doing it too.
Interesting. Mm-hmm. Yeah. Okay, so what are your guys' plans then for the next couple years? And what are some of your goals to use this strategy to keep on buying a bunch of properties, or what do you guys have in the future?
So, yeah, I mean, this strategy is just a better system for what you're already doing to create wealth. It technically could create wealth on its own, but it's not going to create big wealth.
You're just adding gas to the fire of already being a real estate investor. So our goal is basically to get to 300 units, single families in St. Louis, and then kind of do a reassessment. We think we'll be there probably in about 2 years or so. We're going to continue to wholesale, continue to do a few fix and flips, and we're rolling all that money back into cash flowing real estate to grow our passive income.
I think this is fascinating. I mean, if using this as a strategy to get private money, as long as you understand it, you got to have somebody that can explain it easily.
And the Atlas Wealth guys and the E3 guys, we kind of butchered this.
Yeah, it's not something you're gonna get right off the bat. Listen to a podcast or listen to us. We had to listen to a few podcasts, get a few books, talk to some experts, and after doing all that, like one day it's going to click for you. If you understand real estate, understand what you're trying to do as an investor, you're going to see that you can do the same thing with these policies.
So if you're curious, I'd read Nelson Nash's Becoming Your Own Banker first, and then what's Jameson?
Bob Murphy have a book?
What's Jameson's book called?
The Wealth.
The Perpetual Wealth System. I'd read that next because he actually has a chapter about lease to own.
Perpetual Wealth System
by John Jameson.
John Jameson. Yeah, here it is.
And then if you really want to get technical and you're you're interested in economics and Austrian economics in particularly, go on lauramurphy.com, and they do an excellent job explaining to you why this works.
Interesting. Now, the book that you sent me, was that the Perpetual Wealth System book?
No, that was Nelson Nash.
Nelson, okay.
That was... So he pretty much was the person to invent this concept.
Okay.
And the reason he did it is he was a real estate investor, and all his balloons were coming up, and it was during a crash. I forget which one, but he was short on all of his balloons, and he had all this money in life insurance. And he was like, wait a minute, I can take loans from the life insurance, and I can make up for my shortfall on my balloons.
Interesting. Right. Well, cool. Is there, I don't know what happened to Alex. I wish he was here because I know he'd have some more intelligent questions than I do. What do you guys, what's some advice that you would give to people that, they're just getting started into the real estate business. They've wholesaled some houses. They want to take it bigger. What do you recommend they focus on?
I would just focus on I would do a personal diagnosis on what you need to live every month, find out what that number is, and just shoot for getting passive income to equal that number. Because like Rich Dad Poor Dad said, technically you're wealthy at that point. Tim Ferriss's 4-hour workday, he breaks it down into the daily amount of passive income you need a day.
Yeah, that's a good exercise. It's been a long time since I did that.
And I know for us, like once we did that, it gave us a lot more freedom to take other risk and to spend other time learning things because we didn't have, at least I no longer had that immediacy to be out the door at 7:30 in the morning doing what I had to do for a job.
Yeah.
Yeah, like Kiyosaki talks, at that point you're out of the rat race and you can spend your time investing in yourself and learning some high value skills.
Advice wise, spend 2 weeks reading about life insurance.
Well, I think we gave some people some really good resources to look at, and hopefully you guys were taking notes. There's a book called Becoming Your Own Banker. Read that. There's another book called The Perpetual Wealth System by John Jameson. You mentioned the e3wealth.com. You mentioned atlaswealthsolutions.com. Your YouTube channel, Joint Ops Properties. And I also wrote down here the Nelson Nash Institute at infinitebanking.org. People can go there to get more information, right?
Mm-hmm.
And very cool. And again, to get a hold of you guys, jointopsproperties.com. Your email is jointopsproperties@gmail.com. And Autopilot Assets. Talk about what you guys do at Autopilot Assets.
I've got a free webinar up there, but basically it's a online training system showing you how to structure lease option deals. We've got a lot of case studies up there and tips on marketing, all the forms and agreements you'd ever need. But basically, it's our favorite exit strategy is lease options. I know you're a huge fan as well, Joe.
Yeah.
I think a lot of real estate investors are missing that tool in their toolkit, and it's a piece of the puzzle. It's you can make a primary business off of it, but we still do wholesaling. We still fix and flip. But if you're doing those things and you're not doing lease option, I guarantee you're stepping over dollars in your business. There's a lot of those leads you're getting that you could convert into good lease option deals.
Yeah. Very good. Well, thank you guys for the time. I sure appreciate it. You've been very generous with your time. generous with your
Thanks
knowledge.
for talking to us for this long.
Yeah,
most people usually wouldn't do this for us.
Well, I think it's fascinating, and I have a lot of questions still, and I'm looking at this thinking, sounds really interesting. I want to do some more research on it and dig into it.
And Joe, part of the big thing I love it is, one, the tax-free, it passes to my kids tax-free, and two, just as a tool to teach them.
Yeah, that's a real good point. All right, guys.
So our kids aren't going to, be 21 and be like, oh, I have to invest in my qualified plan and save for the long term.
Sure. All right, guys. Thank you, Jimmy Vreeland and Bob Scott. We sure appreciate it. And
thanks, Joe.
We'll talk to you guys later. Take care.